If someone handed you an extra 1,000 euros today, what would you do with it? Would you pay off debt, invest it, add it to your emergency fund, save it for a house, put it into your pension? Most people think there isn't a wrong answer. But depending on where you are financially right now, 4 of the 5 most common answers could actually make you poorer in the long run. Not because they're bad financial decisions, because they're being made at the wrong time. And that's where many people get stuck. Not because they're bad decisions, because they're out of order. And that's where many people get stuck. They work hard. They earn a decent income. They try to do the right things. They save. They invest. They pay down debt. They contribute to retirement. Yet somehow, years later, they still don't feel financially secure. Not because they were lazy, not because they were reckless, but because nobody ever taught them the sequence, the order. And when it comes to building wealth, order matters more than most people realize. In this video, I'm going to show you the 6-layer wealth building system that helps you decide exactly what to focus on next. Whether that's fixing your cash flow, building an emergency fund, tackling debt, investing, saving for a home, or planning for retirement. By the end of this video, you'll know where your next euro should go. And more importantly, why. Here's something most finance channels get wrong. They teach products, they teach ETFs, they teach pensions, they teach mortgages, they teach credit cards. And while all of those things matter, they rarely answer the most important question. What should come first? Because financial products don't build wealth. Financial systems do. Think about building a house. You wouldn't install the roof before laying the foundation. You wouldn't paint the walls before the structure exists. Yet financially, that's exactly what many people do. They start investing before building an emergency fund. They save for retirement while carrying expensive debt. They buy a home before understanding their cash flow. Then they wonder why progress feels slow. The problem isn't usually effort. The problem is sequence. So before we talk about investing, retirement, mortgages, or financial independence, we need a framework, a system. And that's what Money Flow Systems is all about. If you remember nothing else from this video, remember this. Building wealth isn't one decision. It's a sequence of decisions. And those decisions fit into 6 layers. The MFS Wealth System. Layer 1, cash flow. Layer 2, protection. Layer 3, debt strategy. Layer 4, investing. Layer 5, long-term goals. Layer 6, retirement. Take a screenshot of this. By the end of the video, you'll know exactly where you are. Now, that doesn't mean you completely ignore everything above your current layer. You may already have a pension. You may already own investments. You may already have a mortgage. The point is, understanding where your primary focus should be right now. Because if you're trying to solve a layer 4 problem while layer 1 is still broken, wealth building becomes much harder than it needs to be. As we go through these 6 layers, I want you to ask yourself one question. Which layer am I actually on? Because once you know that answer, you'll know exactly what comes next. Let's start with layer 1, cash flow. And before you click away thinking this is just another budgeting lecture, hear me out. Most people think wealth starts with investing. It doesn't. Wealth starts with having money available to invest in the first place. That's what cash flow is, the gap between what comes in and what goes out. Because no matter how good your investment strategy is, no matter how much you know about ETFs, pensions, or retirement planning, none of it works if there's no money left at the end of the month. And this is where many people get stuck. Not because they don't earn enough, but because they don't actually know their numbers. Ask someone how much they spent last month. Most people can't tell you. Ask them how much spare cash they have available each month after all expenses. Most people guess. And that's dangerous, because you can't improve what you don't measure. Now here's something interesting. 2 people can earn exactly the same salary and have completely different cash flow. One earns 60,000 euros a year and has 800 euros left over each month. The other earns 60,000 euros and has 50 euros left over. Same income. Completely different ability to build wealth, which means income alone tells us very little. Cash flow tells us much more. And before you think this is about cutting every coffee or never enjoying life again, it isn't. This isn't about deprivation, it's about visibility. You need to know what comes in, what goes out, and what remains. Because that remaining amount becomes the fuel for every layer that follows. Your emergency fund, your debt strategy, your investments, your retirement plan. Everything starts here. Common mistake. One of the biggest mistakes people make is looking at their current account balance and assuming that's their financial position. But your bank balance isn't your cash flow. €1,000 sitting in your account might already belong to rent, utilities, insurance, car expenses, upcoming annual bills. Until you know what's already spoken for, you don't know what is actually available. What to do this week? Here's your first action step. Open your bank statements for the last 3 months. Not 1 month, 3. Add up total income. Total expenses, then calculate your average monthly surplus. That's your real cash flow. Next, look for leaks. Not because cutting expenses makes you rich, it doesn't, but because every euro saved from something you don't value becomes a euro that can move into the next layer. A forgotten subscription, an expensive bank account, a service you never use. Small leaks create big consequences over years. Real-life example. Imagine an accountant living in Madrid. She earns a decent salary, no major financial problems, yet she always feels like she's falling behind. When she reviews 3 months of spending, she discovers something surprising. Not a huge mistake, just lots of small ones. Unused subscriptions, higher banking fees than necessary, services she forgot she was paying for. Together they add up to roughly €120 per month. That's over €1,400 per year. No side hustle, no salary increase, just visibility. And that €120 per month now becomes the foundation for Layer 2. Because wealth building doesn't begin when you invest. It begins when you create room to invest. Now that you know your cash flow, we move to Layer 2, protection. And honestly, this is the layer most people want to skip. Because it isn't exciting. Nobody brags about their emergency fund. Nobody posts screenshots of their savings account on social media. Nobody says, "Look at the incredible return my emergency fund generated this month." But here's the reality. The emergency fund may be the most underrated wealth-building tool you will ever have. Not because it grows your money, because it protects your future decisions. Think about what happens when life gets expensive. Your car breaks down, the boiler stops working, your laptop dies, a family emergency happens, you lose your job, or your company starts restructuring. None of these events ask whether your investment portfolio is ready. They simply arrive. And when they do, people without a protection layer often make expensive decisions. They take on debt. They use credit cards. They sell investments at the wrong time. Or they start from zero again. This is why protection comes before investing. Not because investing is bad, because investing works best when it isn't constantly interrupted by emergencies. And this is where many people unknowingly sabotage themselves. They hear about index funds. They hear about compound interest. They hear about people becoming millionaires through investing. So they rush straight into the market. Meanwhile, their entire financial life is one unexpected expense away from falling apart. That's not investing. That's gambling with your stability. Quick question. Imagine your employer called you tomorrow and said, "We're making redundancies. Could you cover your essential expenses for the next 3 months?" If the answer is no, Layer 2 isn't finished yet, and that's okay. Remember, this isn't about judging where you are. It's about identifying what comes next. Common mistakes. The first mistake is having no emergency fund at all. The second mistake is investing emergency money. And I see this advice everywhere online. People say your money should always be working, not emergency money. Emergency money has a different job. Its job isn't growth. Its job is availability. If your emergency fund drops 20% right before you need it, it failed its purpose. The third mistake is keeping too much cash. Some people become so focused on safety that they leave years' worth of expenses sitting in cash while inflation quietly erodes its value. Protection is important. But eventually, you must move forward. What to do? This week, start with a target. Not a vague goal, a number. Calculate your essential monthly expenses, not lifestyle expenses. Essentials. Things like rent or mortgage utilities, food insurance, transportation. Now multiply that by 3. For many people, that's a good starting emergency fund target. If your job is less stable or you're self-employed, 6 months may make more sense. Then open a separate savings account specifically for emergencies. Not your daily spending account, not your investment account. A dedicated protection account. And automate contributions. Even €50 or €100 a month is progress. Because consistency beats intensity. Real-life example. Imagine a project manager in Berlin. She earns a good salary. She's investing €300 every month into index funds. Everything looks great. Then her car needs major repairs. The bill is €1,200. She doesn't have an emergency fund. So she sells investments to cover the cost. Unfortunately, the market happens to be down. Now she's sold assets at a loss, stopped her investing plan, and has to start rebuilding. The repair wasn't the problem. The missing protection layer was. Now imagine the same situation with a properly funded emergency account. The bill gets paid. The investments stay untouched. The monthly investing continues. The long-term plan survives. Same emergency, completely different outcome. And that's why Layer 2 exists. Not to make money, to protect the money-making system. Let's talk about debt, because this is where financial advice often becomes confusing. Some people will tell you, all debt is bad. Others will tell you, use debt to build wealth. And depending on who you listen to, both can sound convincing. The problem is that they're talking about different types of debt. And if there's one thing I want you to remember from this section, it's this. Not all debt deserves the same response. Because a credit card charging 24% interest and a mortgage charging 3% interest are not the same problem, yet many people treat them as if they are. And that can cost them thousands of euros over time. What debt actually does? Debt isn't just a payment. Debt is a claim on your future cash flow. Every euro you owe is a euro that can't be used elsewhere. It can't build your emergency fund. It can't be invested. It can't help you reach long-term goals. And the higher the interest rate, the more aggressively that future cash flow gets consumed. This is why debt strategy comes before investing. Because before we focus on growing money, we need to stop unnecessary money from leaving the system. The 2 types of debt for simplicity, I want you to think about debt in 2 categories. Destructive debt. This is debt that funds consumption, carries high interest, doesn't create lasting value. Examples: credit card balances, buy now, pay later. Balances, personal loans for holidays. Consumer electronics financing, high interest car loans. This debt actively works against wealth building. Every month it takes money away from future you. Productive debt. This is debt that may support income growth, help acquire an asset, carry relatively low interest. Examples: many mortgages, certain student loans, some business-related borrowing. Now notice something important. I didn't say productive debt is automatically good. I said it's different. Because even productive debt must fit into a broader financial system. This is where many people make mistakes. Common mistake number 1. Treating all debt equally. Imagine 2 people. Person A has €4,000 on a credit card at 22%, a mortgage at 3%, and they decide to overpay the mortgage because I want to be debt-free. The problem? The mortgage isn't the fire. The credit card is. They're solving the wrong problem first. Common mistake number 2, investing while carrying expensive debt. This one is extremely common. Someone invests €200 every month. Meanwhile, they're paying 20% interest on credit card debt. Now ask yourself, what investment is guaranteed to return 20% every year? Almost none. Paying off that debt first is often one of the best financial returns available. Not because investing is bad, because math matters. Quick question. If I offered you a guaranteed 18% return with 0 risk, would you take it? Most people would. Yet many people ignore exactly that opportunity when they leave high-interest debt unpaid. Common mistake number 3. obsessing over becoming debt-free at all costs. This might sound strange after everything we've discussed, but some people become so focused on eliminating every debt that they neglect everything else. No emergency fund, no investing, no retirement planning, nothing. Every spare euro goes toward low-interest debt. And while reducing debt feels productive, it's important to remember, the goal isn't to become debt-free. The goal is to become wealthy. Those are not always the same thing. What to do this week? Pull up every debt you currently have. Every single one. Create a simple list. Write down total balance, monthly payment interest rate. Now sort them by interest rate, not by balance, not by monthly payment. Interest rate. Then ask, which debts are actively slowing down my financial progress? Those become priority targets. For most people, that means attacking high-interest consumer debt first, while continuing minimum payments on lower-interest obligations. This approach is often called the avalanche method, and over time it usually saves the most money. Real-life example. Let's imagine an engineer in Amsterdam. He has €3,500 on a credit card at 21%, a car loan at 6%, a mortgage at 3%. Every month, he has €300 available after expenses. Initially, he spreads the €300 evenly across all three debts. It feels balanced, fair, responsible, but it's inefficient. Instead, he directs the entire €300 toward the credit card while making minimum payments elsewhere. The credit card disappears much faster. Thousands of euros in future interest are avoided. Then that same €300 rolls onto the car loan, and eventually into investing. Notice something important. The wealth-building system didn't become stronger because he worked harder. It became stronger because he focused on the right priority. And that's the theme you'll keep seeing throughout this framework. The right decision at the wrong time can still be the wrong decision. Now, we arrive at the layer most people have been waiting for: investing. This is where things get interesting. It's where people start talking about ETFs, index funds, compound interest financial independence building long-term wealth. And honestly, that's a good thing. The desire to invest is usually a sign that someone is thinking about their future rather than just their next paycheck. But here's where many people go wrong. They hear about investing, they hear stories about market returns. They see people online discussing portfolios, and they immediately assume, I need to start investing right now. Sometimes that's true. Sometimes it isn't. Because investing isn't layer 1, it isn't layer 2, and it isn't layer 3, it's layer 4. And if the foundation underneath it isn't stable, investing often becomes frustrating instead of powerful. Why investing comes fourth? Let's imagine two people. Both decide to invest €300 every month into a diversified index fund. Sounds great. But person A has no emergency fund, unpredictable cash flow, high interest debt. Person B has clear cash flow, emergency savings, high interest debt under control. 3 months later, both face an unexpected expense. Person A sells investments. Person B doesn't. Person A interrupts the process. Person B stays invested. 5 years later, which person is more likely to benefit from compounding? The answer isn't about investment skill, it's about preparation. This is why MFS teaches systems first, products second, because the best investment in the world can't fix a broken financial foundation. What investing actually is simply the process of putting money to work for future goals. That's it. Not gambling, not guessing, not chasing trends, not trying to become rich next month. For most ordinary investors, investing means owning small pieces of thousands of businesses through diversified index funds and allowing time to do the heavy lifting. Because time is the real engine, not stock picking, not market predictions, not financial headlines. Time. The power of compounding. Imagine investing €300 every month. Nothing dramatic happens, no overnight success, no viral trading strategy, no miracle stock, just consistent investing, month after month, year after year. At first it feels slow, almost disappointingly slow. Then something interesting happens. Your money starts generating returns. Those returns generate their own returns, and eventually growth begins accelerating. This is compounding. and it's one of the closest things finance has to a superpower. The challenge is that compounding rewards patience, while human beings naturally want immediate results. Common mistake number 1, trying to get rich quickly. This is where people abandon proven wealth-building strategies for speculation, a hot stock, a market prediction, a trend everyone is suddenly talking about. The problem: most people underestimate how difficult it is to consistently outperform the market, and they overestimate their ability to identify winners in advance. Common mistake number 2, waiting for the perfect time. You've probably heard this before. People saying, "I'll start investing when the market falls," or "I'll start after the next election," or "I'll start when things feel more certain." The problem is that certainty rarely arrives, and while you're waiting, time keeps moving. Quick question: if investing is supposed to be a 20-year decision, why are so many people making decisions based on what might happen next month? That's worth thinking about. Common mistake number 3, using long-term investments for short-term goals. This is one of the most expensive mistakes people make. Let's say you're saving for a house deposit you'll need in 2 years. You see that long-term stock market returns look attractive, so you invest the money. Then 6 months before buying the house, markets fall significantly. Now what? The investment wasn't bad. The timing was, because the investment didn't match the goal. And this is where MFS differs from many finance channels. The question isn't, is investing good? The question is, good for what? The goal determines the tool, not the other way around. What to do this week? If layers 1, 2, and 3 are solid, start. Not perfectly, just start. Set up an automatic monthly contribution. Even a small amount matters. Focus on consistency, not perfection. If layers 1, 2, or 3 still need work, don't feel behind. Your priority isn't investing yet. Your priority is strengthening the foundation that will eventually support investing. Remember, investing works best when it becomes boring, because boring usually means you're following a plan. Real-life example. Let's take an engineer in Munich. She has positive cash flow, a fully funded emergency fund, no high-interest debt. After reviewing her finances, she realizes she can comfortably invest €400 per month. Instead of spending months researching the perfect investment, she sets up an automatic monthly contribution into a diversified long-term portfolio. Then she leaves it alone. A year later, markets fall. News headlines become negative. People panic. She continues investing because nothing about her goals has changed. 5 years later, she has contributed consistently through both good markets and bad. Not because she predicted anything, because she built a system. And systems outperform emotions surprisingly often. Now we arrive at a layer that most people completely overlook: long-term goals. And the reason they overlook it is simple. Most financial advice jumps straight from investing to retirement, as if every financial goal in life exists somewhere between those 2 points. But that's not how real life works. Because before retirement arrives, life happens. You might want to buy a home, start a family, help pay for your children's education, launch a business, take a career break, move countries, reach financial independence. These goals don't just happen. They require planning. And more importantly, they require money. This is why Layer 5 exists, because investing without a goal is like getting into a car and driving without a destination. You might be moving, but are you actually getting anywhere? The problem: most people don't realize. Many people start investing before they know what they're investing for. They hear, investing is good, which is true. But investing is a tool, and tools work best when you know what you're trying to build. Let's say 2 people each invest €500 per month. Same amount, same investments, completely different goals. The first person wants to buy a house in 4 years. The second person wants to retire in 30 years. Should they have exactly the same strategy? Probably not. The goal matters. The timeline matters. The risk they're willing to take matters. And that's why every financial decision should start with a question. What is this money supposed to do for me? Common mistake number 1. Treating all savings as one giant pile. Many people have a single account. Everything goes into it. Emergency savings, holiday money, house deposit, investments, future plans. Everything mixed together. The problem? When money has no job, it's easy to spend it on the wrong thing. Common mistake number 2. Ignoring the timeline. A goal that's 2 years away should not be treated the same as a goal that's 20 years away. And yet people do this all the time. They take short-term money and expose it to long-term risks. Or they keep long-term money sitting in cash for decades. Both can be costly mistakes. Quick question. If I asked you today, what are your 3 biggest financial goals over the next 10 years? Could you answer immediately? Many people can't. Not because they don't care, because they've never taken the time to define them. And that's where confusion begins. Common mistake number 3. Copying someone else's goals. This is more common than people realize. Social media makes it easy to believe everyone should want the same things. Buy a house, retire early, build a huge portfolio, start a business. But your financial system should reflect your goals, not someone else's, because wealth isn't measured by how closely your life resembles another person's. It's measured by whether your money is helping you build the life you actually want. What to do this week? Take a piece of paper or open a document and write down your top 3 long-term financial goals. Be specific, not "I want more money." Instead, "I want a €50,000 house deposit within 5 years," or "I want the option to reduce my working hours by age 55," or "I want to help fund my children's university education." Then write a target amount, a target date, and estimate how much you'll need to save or invest each month, because vague goals create vague results. Specific goals create plans. Real-life example. Imagine a teacher in Dublin. She's investing consistently every month. Everything looks fine. Then someone asks her, "What are you investing for?" And she realizes she doesn't really know. She knows she wants financial security, but she hasn't defined what that means. So she sits down and identifies 3 goals. House deposit in 6 years. Financial flexibility by age 55. Additional retirement income later in life. Now every euro has a purpose. Every decision becomes easier. Because she isn't just investing. She's funding future outcomes. And that's the difference. Investing grows money. Goals give money direction. Goals. And now we arrive at the final layer. Retirement. The layer that many people avoid thinking about for as long as possible. And honestly, that's understandable. If you're in your 20s, 30s, or even 40s, retirement can feel incredibly far away. You have more immediate concerns: bills, housing, family, career, daily life. Retirement feels like a future problem. But here's the uncomfortable truth. The earlier you think about retirement, the easier it becomes. The later you think about retirement, the fewer options you have. And that's why retirement belongs in your wealth building system from the very beginning. Not because it should be your biggest priority today, but because time matters. Remember when we talked about investing and compounding? Retirement is where compounding does its best work. Because retirement isn't usually built through one big decision. It's built through thousands of small decisions repeated consistently over decades. The biggest retirement mistake. One of the biggest financial mistakes people make is assuming retirement will somehow work itself out. They assume, "I'll earn more later," or "I'll start focusing on retirement once I'm older," or "the state pension will take care of it." And while state pensions play an important role across Europe, relying entirely on them can be risky. Policies change, costs of living change, personal circumstances change, and nobody knows exactly what retirement systems will look like 30 years from now. That's why your retirement plan shouldn't depend on hope. It should depend on preparation. Quick question. Imagine your future self at age 65. Would that version of you thank today's version for delaying retirement planning? Probably not. Future you is counting on decisions that current you makes right now. And that's what makes retirement different from every other financial goal. You can delay buying a bigger house, you can postpone a holiday, you can change many life goals. But retirement keeps getting closer, whether you're ready or not. Common mistake number 1. Starting too late. Let's look at 2 people. Both eventually want the same retirement outcome. The first starts investing at age 30, the second starts at age 45. The second person may need to contribute significantly more money every month to catch up. Not because they're less disciplined, because they have less time. And time is one of the most valuable assets an investor has. Common mistake number 2, never checking retirement projections. Many people contribute to workplace pensions or retirement plans without ever reviewing them. Money goes in. Years pass, and they assume everything is fine. But assumptions are not plans. At least once a year, it's worth understanding what you currently have, what you're projected to have, whether that's likely to support the lifestyle you want. Common mistake number 3, treating retirement as a separate topic. This is where the MFS Wealth System becomes powerful. Retirement isn't separate from cash flow protection, debt strategy, investing, long-term goals. Retirement depends on all of them. If your cash flow is broken, retirement suffers. If debt consumes your income, retirement suffers. If investing never begins, retirement suffers. Every layer supports the one above it. That's why we've spent this entire video building the system from the ground up. What to do this week? Take 30 minutes. That's it, 30 minutes. Find out what retirement benefits you may already have, what workplace pension arrangements exist, what personal retirement savings you currently hold, what your projected retirement income could look like. Don't worry about having all the answers. Just create awareness. Because awareness is where planning begins, and planning is where progress begins. Real life example. Imagine a nurse in Paris. She's in her early 30s. Retirement feels decades away, so she focuses entirely on present-day expenses. Years pass. Then one day she decides to review her retirement position. What she discovers surprises her. She isn't in bad shape. But she realizes that small contributions started today could dramatically improve her future options. Not because they guarantee wealth, because they give her flexibility. And that's what retirement planning is really about. Options, choices, freedom, the ability to decide how you spend your time later in life. And those choices are often created years before you need them. Let's bring everything together. Most people think building wealth is about finding the perfect investment, the perfect ETF, the perfect stock, the perfect retirement plan, the perfect strategy. But after everything we've discussed today, hopefully you can see that's not really the challenge. The challenge is building the system. Because the truth is, the right financial product at the wrong stage can still be the wrong decision. An investment isn't helpful if you have no emergency fund. An emergency fund won't build long-term wealth by itself. Paying off low-interest debt while ignoring retirement might not move you closer to your goals. Everything has a place. Everything has a purpose. Everything has an order. And that's exactly what the MFS Wealth System is designed to help you understand. Layer 1. Cash flow. Layer 2. Protection. Layer 3. Debt strategy. Layer 4. Investing. Layer 5. Long-term goals. Layer 6. Retirement. When these layers work together, wealth building becomes simpler. Not easy, but simpler. Because instead of asking, what's the best financial product, you start asking, what's the right next step for me? And that question usually leads to better decisions. Before you leave, I want you to do one thing. Don't try to fix all 6 layers this week. Just identify where you are. If your cash flow isn't clear, focus on layer 1. If you have no emergency fund, focus on layer 2. If high interest debt is holding you back, focus on layer 3. If your foundation is already in place, move to layer 4 and start investing consistently. The goal isn't to do everything. The goal is to do the right thing next, because wealth isn't built through one perfect decision. It's built through thousands of correct decisions, repeated over time. Now I'd like to hear from you. Which layer of the MFS Wealth System are you currently working on? Cash flow, protection, debt strategy, investing, long-term goals, or retirement? Let me know in the comments below. And if this video helped you see your finances more clearly, consider subscribing. Because in future videos, we'll go deeper into each layer of the system. We'll cover emergency funds, debt repayment strategies, index fund investing, retirement planning, mortgages, financial independence. and the decisions that have the biggest impact on long-term wealth. Most finance channels teach products. Here at Money Flow Systems, we'll focus on helping you build the system. Thanks for watching, and I'll see you in the next video.